Hello, my name is Troy Atkins, and I am the founder and owner of Atkins Capital Management. I want to talk to you today about the key housing events that have transpired in the U.S. during the second quarter of 2017. During the second quarter of this year, a report titled Addressing the Housing Finance Conundrum by BlackRock Investment Management Company, the annual State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University, and the actions and implications of the monetary policy set forth by the Federal Reserve were the primary topics of discussion. This movie presentation also provides an overview of the home price level for a select group of cities that make up the Atkins 60 City Home Price Index. This presentation also provides a wealth of information for prospective homebuyers to use in order to make a prudent home purchase decision. This presentation was written, narrated, edited, produced, and published by Troy Atkins. I am the founder and owner of Atkins Capital Management. Atkins Capital Management is a privately owned and independently operated company. The exclusive focus of my company is on residential real estate. My company is not affiliated with any parties associated with the residential housing industry. The mission of my company is to bridge the gap in the residential housing market, where deficiencies in education, public policy, regulation, product structure, and personnel have created an environment where prospective homebuyers need objective information and useful analytical tools in order to help them make a prudent home purchase decision. As an investment professional, I have more than 15 years of real estate analysis experience, more than 10 years of institutional investment consulting experience, and more than 8 years of freelance financial writing experience. I am also the author of more than 25 published investment articles. For more information about my background, skills, and experience, please visit the Atkins Capital Management website. With this overview in mind, let me now turn your attention to the primary events that have transpired in the residential housing environment. For the second quarter of 2017, a comprehensive research viewpoint by BlackRock Investment Management Company titled Addressing the Housing Finance Conundrum was the primary topic of discussion. The BlackRock viewpoint was written with the best interests of investors in mind. In contrast, the recommendations set forth in this presentation by Atkins Capital Management are written with the best interests of prospective homebuyers in mind. From the standpoint of Atkins Capital Management, the primary benefits of the BlackRock viewpoint are threefold. First, the viewpoint provides a helpful overview of the state of the nation's housing. Second, the viewpoint provides an excellent overview of the 6 policy proposals that have been set forth for the ongoing operation of the government-sponsored enterprises. And third, the viewpoint provides valuable housing policy insight from the perspective of one of the largest fixed income investment managers in the world. Overall, the viewpoint of the BlackRock report is that the U.S. needs a comprehensive approach to its housing finance policy. Accordingly, there is a need for a clearly defined governmental role, transparency at all levels, and a framework to attract private capital. According to the BlackRock viewpoint, housing prices in most markets have largely recovered from the historic lows associated with the housing crisis. As a result, many constituencies are pushing for a timely change in the structure and operation of the government-sponsored enterprises. In contrast to the BlackRock viewpoint, a recent report by Trulia found that when comparing the nominal value of each home in the U.S. as of March 1st, 2017, to the nominal peak value of that home prior to the onset of the Great Recession, just 34.2% of homes nationally have seen their value surpass their pre-recession peak. According to Trulia, we won't see 100% of homes reach their pre-recession peak home price level until approximately September of 2025. On a positive note, most zip codes in the flyover states have seen at least half of their homes recover to their pre-recession peak. Outside of the major metros, the interior of the country has a higher share of recovered homes than coastal ones. Given the Trulia research, Atkins Capital Management has reached the following analytical conclusions. First, an evolution in U.S. housing policy needs to move at a slow and steady pace until an accurate assessment of the state of the nation's housing can be determined. Second, given the uncertainty in U.S. housing policy, prospective homebuyers need to study the long-term implications of owning a home and take into account that the financial implications of owning a home may be detrimental to most people's long-term net worth. And third, the financial benefit of owning a home may only be experienced by homeowners that have a long-term time horizon. This finding has been confirmed many times by conducting an analysis using the Atkins Residential Home Valuation Analyzer. According to numerous people in the residential housing industry, identified problems in the accuracy of the highly popular Zillow's estimate raises a host of issues that need to be addressed by prospective homebuyers and existing homeowners in terms of evaluating the price level of homes in their community. A Zillow competition, marketed as Zillow Prize, has been launched in order to find a person or team who can most improve the Zestimate algorithm, which is Zillow's proprietary home valuation tool and is used to generate automated home valuations for 110 million homes across the U.S. The winner of the Zillow Prize competition will be awarded $1 million. Given the findings associated with the Zillow's estimate, Atkins Capital Management has reached the following analytical conclusions. Automated valuation processes offered by digital companies will never generate an accurate home valuation analysis for prospective homebuyers to use in order to make a prudent home purchase decision because they do not take into account all of the analytical factors that are required to make a prudent home purchase decision. Automated valuation processes can be useful in terms of helping the seller set the initial offering price for a home that is to be sold on the market. In light of the problems with the Zillow's estimate, prospective homebuyers will need to use an independent residential real estate analysis software application, such as the Atkins Residential Home Valuation Analyzer, in order to help them make a prudent home purchase decision. Based on the housing information provided in the BlackRock Viewpoint, the conflicting housing recovery data associated with the BlackRock Viewpoint versus the Trulia research, and the identified problem with the Zestimate, Atkins Capital Management recommends that prospective homebuyers take into account the following points of view when they evaluate their home purchase opportunities. First, an analytical distinction needs to be made between the price and the value of a home. Second, the philosophy that price does not equal value needs to be understood and embraced. An understanding of this principle is required in order to have the ability to make a prudent home purchase decision. Third, individual decisions based on an understanding between price and value will help maintain a stable housing environment for society as a whole. Fourth, traditional valuation approaches that use market comparables are only useful for helping a seller set the initial offering price for a home that he or she is trying to sell. Fifth, digital companies using automated analytical systems to amalgamate information provide limited value in making a prudent home purchase decision, because such valuation processes do not utilize the specific prospective home buyer information that is required in order to conduct an accurate residential real estate analysis. 6. There are no shortcuts to conducting a comprehensive residential real estate analysis. Companies that provide quick and easy valuation solutions offer virtually no value for making a prudent home purchase decision. And finally, prospective home buyers need to use the proprietary finance-based analytical methodology in conjunction with the proprietary expense-based analytical methodology developed by Atkins Capital Management in order to be able to make a prudent home purchase decision. The BlackRock report also provides a great overview of both the government-sponsored enterprises role and the Federal Reserve's role in the U.S. housing market. According to the BlackRock viewpoint, Fannie Mae and Freddie Mac have paid more than $68 billion of their cumulative draw following their placement into conservatorship and are currently generating positive pre-tax income each quarter. According to research conducted by Atkins Capital Management, in 2016, Fannie Mae and Freddie Mac purchased approximately $941 billion of single-family mortgages. The total loan market value of single-family mortgages is $2 trillion. In addition, the mortgage-backed securities issued by Fannie Mae and Freddie Mac accounted for 65% of all mortgage securities backed by single-family loans. As of January of 2009, the Federal Reserve held $1.8 trillion on its balance sheet as a result of its quantitative easing policies. The following charts illustrate the exorbitant role that the U.S. government plays in the U.S. residential housing market. Based on the information in the BlackRock viewpoint, Atkins Capital Management has reached the following policy conclusions. First, the role of the U.S. government's housing policy via the GSEs and the Federal Reserve are too extensive to be funded by the private capital market in a material way. Second, it is clear that future U.S. housing policy pertaining to the GSEs will have to be designed according to the way things are rather than to the way things should be. Given the fact that the GSEs will be running on zero capital by the first part of 2017, it is highly likely that housing policy will be high on President Trump's administrative policy agenda in the near future. Third, the Federal Reserve will have to unwind its mortgage-backed security holdings on its balance sheet over a long period of time in order for private capital to take a leading role in U.S. housing policy administration. And fourth, the Federal Reserve's policy to unwind its exposure to mortgage-backed security holdings will have to take place in concert with its tightening monetary policy. With this in mind, mortgage loan interest rates are trending down, which is counterintuitive to the historical relationship between the federal funds rate and mortgage loan interest rates. Therefore, a better understanding of this financial anomaly will need to be evaluated in order to understand this phenomenon and its impact on future housing policy. Atkins Capital Management has published a wealth of analytical information about the role of the GSEs and the Federal Reserve's role in the U.S. housing market in its quarterly residential housing reviews. We have provided the following links in our presentation to ease your assistance in evaluating and reviewing our movie presentations. The BlackRock report also outlines the 6 policy recommendations for the future operation of the government-sponsored enterprises known as Fannie Mae and Freddie Mac. In addition, the report provides a clear and concise summary of their opinion for each of the proposed policies. Atkins Capital Management has provided its analytical assessment of each of the 6 policy proposals, independent of the recommendations set forth in the BlackRock viewpoint. The first policy proposal is the PATH Act. This policy would eliminate Fannie Mae and Freddie Mac over a 5-year period, accelerate the reduction of their portfolio, and seek to attract private capital to the mortgage lending industry. After analyzing the PATH Act, ACM believes that this policy is based on the way the housing industry should operate, but is not a feasible solution due to the fact that it is virtually impossible to unwind the exorbitant role that the U.S. government currently plays in the housing market without having a dramatic impact on society. This policy would also dramatically change the concept of the American dream by significantly reducing the amount of mortgage lending capital that is available to prospective home buyers. This in turn would reduce the number of homeowners nationwide. This policy would also increase the cost of mortgage lending capital, as interest rates on mortgage loans would have to increase dramatically in order to attract private capital to the mortgage lending industry to a level that meets current demand as defined by annual home buyers. Overall, the PATH Act would curtail the demand for home purchases, which would push down home prices. This policy would cause the housing industry to decrease dramatically. This policy would shift U.S. housing policy from homeowners to renters, and this policy would likely be contested by parties that earn a living from the housing industry. The second policy proposal is the Johnson-Crapo bill. This policy would eliminate Fannie Mae and Freddie Mac, establish the Federal Mortgage Insurance Corporation, and provide an explicit full faith and credit guarantee on covered mortgage-backed securities following a 10% first loss credit support provision from private capital. The bill also calls for guarantors with a regulator and standardized policies, practices, and documentation for mortgage-backed securities utilizing a common securitization platform. It is important to note that this bill is not supported by key Democratic leadership, including Senator Schumer and Senator Warren. After analyzing the Johnson-Crapo bill, ACM believes that the establishment of a new governmental agency is not a solution to the future operation for the state of the nation's housing. Therefore, ACM believes that such legislation should not be endorsed. ACM does not believe that the U.S. government should provide an explicit guarantee for GSE mortgage-backed securities. ACM believes that the establishment of a new governmental agency will simply promote more of the same bad housing policies that will ultimately lead to another housing debacle. ACM does not believe that the U.S. housing industry needs more regulation. And ACM does believe that a common securitization platform is a valid provision for the GSEs. The third policy proposal is known as the Promising Road Proposal. This policy would move the GSEs into a single wholly owned government corporation known as the National Mortgage Reinsurance Corporation. The Promising Road Proposal would provide an explicit government guarantee and calls for laying off a portion of the credit risk to taxpayers in the capital markets. After analyzing the Promising Road Proposal, ACM has reached the same conclusion as it reached for the Johnson-Crapo bill. ACM believes that private capital should be used to fund the housing industry, and ACM believes that credit risk should be covered by private capital investors instead of taxpayers. The fourth policy proposal is known as the MBA proposal. This policy would convert the GSEs into privately owned regulated utilities with regulated rates of return that issue mortgage-backed securities with explicit guarantees. After analyzing the MBA proposal, ACM believes that this type of government regulation would be ineffective because regulators typically come from the industry that they are supposed to regulate. They tend to have the same warped viewpoints that necessitate regulation. They tend to form biased relationships with those that they are supposed to regulate, and they tend to adopt the views of those they regulate over time. This in turn makes the regulation of the financial services industry uneconomical, inefficient, and ineffective. In addition, ACM does not believe that the U.S. government should provide an explicit guarantee of GSE mortgage-backed securities. The fifth policy proposal is known as the Milken Institute proposal. This policy would convert the GSEs into cooperatively owned front-end credit enhancers. This policy proposal would guarantee mortgage-backed securities, and this policy proposal also promotes the use of the Ginnie Mae operational model. After analyzing the Milken Institute proposal, ACM believes that more information about cooperatively owned front-end credit enhancers is needed to be disclosed. Typically, when policy solutions utilize unclear terminology or complex ideas that are not clear and concise and easy to understand in terms of purpose, process, and anticipated outcome, they are not feasible long-term solutions. In addition, ACM does not recommend an implicit or explicit governmental guarantee of GSE mortgage-backed securities. However, ACM does recommend the promotion of the Ginnie Mae operational model. The Milken Institute proposal will be evaluated in greater detail if it gains traction with policymakers. The sixth policy proposal is known as the Recap and Release proposal. This policy calls for a suspension of dividend payments to the U.S. Treasury, allowing the GSEs to build sufficient capital to eventually be released from conservatorship. The future state of the GSEs would keep private shareholder-owned entities with an implicit government guarantee. After analyzing the Recap and Release proposal, ACM has reached the conclusion that it is the most realistic option given the size of the role that the U.S. government plays in the U.S. housing market. ACM also believes that the Recap and Release policy is the best solution given the state of the nation's housing and given the current concept that people have of the American dream. However, ACM does not believe that an implicit government guarantee should be associated with GSE mortgage-backed securities. ACM supports the suspension of dividend payments to the U.S. Treasury, which should allow the GSEs to recapitalize over time. Overall, ACM believes that the Recap and Release policy should serve as a temporary solution for U.S. housing policy as an evolution following the PATH Act policy proposal is achieved. The following overview is a summary of the housing policy proposal that is supported by Atkins Capital Management. ACM believes that an evolution needs to take place from one end of the policy spectrum to the other, as a transition takes place in housing policy from exorbitant government involvement to minimal government involvement over time. ACM recommends the temporary adoption of the Recap and Release policy. ACM recommends a policy initiative that promotes a feasible evolution from the Recap and Release policy to the policies outlined in the PATH Act. ACM recommends the elimination of the implicit government guarantee for GSE mortgage-backed securities and does not recommend a policy that puts in place an explicit governmental guarantee. ACM recommends that investors ignore the ratings agencies. because they are paid by the companies that they rate. ACM recommends the promotion of policies that require investors in GSE mortgage-backed securities to determine the risk of investing in a GSE mortgage-backed security before making a capital investment. ACM recommends providing access via the GSE websites to all of the underlying mortgage loan information that make up every loan in a GSE mortgage-backed security, so that investors have the ability to conduct a thorough investment analysis. ACM recommends GSE mortgage-backed securities be prohibited from including low credit quality mortgages. ACM recommends that equity investors in the GSEs, prior to their placement in conservatorship, lose 100% of their equity investment. ACM recommends that equity investors in the GSEs following their placement in conservatorship maintain their equity position at a non-diluted value. ACM recommends the use of guarantee fees to be held by the GSEs in order to increase their capital reserves. For the second quarter of 2017, the annual release of the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University provided a wealth of information pertaining to the residential housing environment. The general theme of the JCHS report is that the U.S. housing market has overcome the worst effects of the housing bust. Nominal house prices have regained previous peaks. Construction volumes are nearing their long-term averages. Household growth is becoming more balanced between the owner and renter markets, and the need for additional housing supply should be an important stimulus for economic growth. According to researchers at the JCHS, attending to the nation's critical housing challenges should have primacy in the debates over public spending, tax policy, and regulatory regimes. The following information is a summary of the key findings for 2016 that are most pertinent to prospective homebuyers and existing homeowners. In 2016, U.S. home prices finally surpassed the high reached nearly a decade earlier. On an inflation-adjusted basis, national home prices remain nearly 15% below their previous high. In 2016, more than 6 million homes were sold. The national home ownership rate dipped again for the 12th consecutive year to 63.4%. And the median sales price for an existing home was $233,800. The following information is a summary of more key findings from the State of the Nation's Housing Report. The rebound in home prices differs sharply across neighborhoods by income. Markets along the east and west coasts have seen inflation-adjusted home values increase, while metros in large swaths of the Midwest and South have experienced declines. In 2016, the number of homeowners underwater on their mortgage loan was 3.2 million. In comparison, in 2011, 12.1 million homeowners were underwater on their mortgage loans. Foreclosure inventory was 585,000 properties. In 2016, construction of single-family homes was 781,600. It is important to note that construction levels have been below 1 million units every year since 2008. And until the housing crash, the below 1 million level was only posted 5 times since 1976. Single-family construction remains skewed towards larger, more expensive homes. Small, single-family homes represented 21% of all completions. With a steady increase in demand and the low rate of new construction, The gross vacancy rate is at its lowest level since 2000. The lack of inventory is evident in both the new and existing housing stock. Home ownership declines are moderating, while rental demand is strong, and affordability pressure is widespread. In the future, it is anticipated that minorities will drive most future household income growth. Buyers will tend to be younger, have children, and be of Asian or Hispanic descent. Based on the housing information provided in the State of the Nation's Housing Report by the Joint Center for Housing Studies of Harvard University, Atkins Capital Management recommends that prospective homebuyers take into account the following points of view when they evaluate their home purchase opportunities. First, it is easy to find conflicting information about the state of the nation's housing today. While the Harvard report paints a positive outlook for the home price recovery of homes across the U.S., a recent Trillia report paints a much more negative picture. Second, given the length of time it has taken home prices to recover from the housing calamity, the millions of people that have lost their homes to foreclosure, the millions of people that are still underwater on their mortgage loan, and the number of people that are financially constrained by the costs associated with owning a home, prospective homebuyers should analyze home ownership very thoroughly. Third, the Federal Housing Administration continues to play a central role in serving first-time homebuyers. Unfortunately, the reason why FHA loans are so popular is because the FHA program only requires a 3.5% down payment amount. While FHA loans help spur the housing environment and help people that work in the housing industry, such policies are very bad from the financial perspective of prospective homebuyers. Fourth, the overall outlook of the information provided in the JCHS State of the Nation's Housing Report clearly confirms that prospective homebuyers need assistance with making a prudent home purchase decision. Fifth, prospective homebuyers should realize that housing policy is created by our policymakers in order to help spur the housing environment, and that housing policy is not created with the best financial interests of prospective homebuyers in mind. And six, prospective homebuyers need to use an independent and objective residential real estate analysis software application like the Atkins Residential Home Valuation Analyzer in order to help them make a prudent home purchase decision. Moving away from these policy issues and events and to an assessment of the mortgage lending environment, it is important to note that for the second quarter of 2017, the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan began the quarter at 4.19% and ended the quarter at 4.07%. Since June of 2011, the national average mortgage loan interest rate for a 30-year fixed-rate loan has been less than 4.61%. In order to better assess the current mortgage loan interest rate environment, prospective homebuyers should remember that the national average mortgage loan interest rate for a 30-year fully amortized fixed-rate loan reached an all-time low of 3.31% in November of 2012, and it reached an all-time high of 18.63% in October of 1981. In view of realized and expected labor market conditions and inflation, the Federal Reserve elected to raise the target federal funds rate 25 basis points during their Q2 2017 Federal Open Market Committee meeting. Prospective homebuyers should closely follow the level of mortgage loan interest rates in their community because a rising cost of debt will increase the amount of interest expense that prospective homebuyers will need to pay for their mortgage loan. This in turn will place downward pressure on the price level of residential housing in their community. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to assess the impact of a changing interest rate environment. Now that I have provided an overview of the events that have taken place in the residential housing environment for the quarter, let me turn your attention to the proprietary financial methodology and cloud-based analytical tool that can be used to provide an assessment of the price level of homes in a community. The Atkins Residential Home Valuation Analyzer is an internet-based software application that analyzes the relationship between the median home price level for a city and the median household income level for the city. With this information, the software application takes into account the most recent month-ending national average mortgage loan interest rate for a 30-year fully amortized fixed-rate mortgage loan, and the assumption that no more than 28% of pre-tax household income should be spent by homeowners in order to repay the principal and interest costs for their mortgage loan. By utilizing this information, the Atkins Residential Home Valuation Analyzer can accurately assess the price level of homes in a city. From the first analytical perspective, the Atkins Residential Home Valuation Analyzer determines the level of underpricing or overpricing of homes in a city by calculating the mortgage loan interest rate that justifies the price level of homes in the city. With this information, the justified mortgage loan interest rate is compared against the national average mortgage loan interest rate in order to accurately assess the level of underpricing or overpricing of homes in a city. From the second analytical perspective, the Atkins Residential Home Valuation Analyzer calculates the percentage of household income that would have to be spent by the people that live in a city in order to justify the price level of homes in the city. With this information, the justified percentage of household income amount is compared against the traditionally accepted household income amount of 28% in order to accurately assess the level of underpricing or overpricing of homes in the city. By utilizing the Atkins Residential Home Valuation Analyzer, prospective homebuyers can determine the level of underpricing or overpricing of homes in a community in order to assist them in making a prudent home purchase decision. For more information about our finance-based analytical methodology and the Atkins Residential Home Valuation Analyzer, please watch our review of residential real estate analysis valuation methodologies movie presentation and our residential real estate analysis software application movie presentation. Both of these presentations can be found on the Atkins Capital Management website. For the second quarter of 2017, 16 cities that make up the Atkins 60 City Home Price Index were classified as overpriced for the quarter. San Francisco, New York City, San Diego, Seattle, and Los Angeles were identified as the 5 most overpriced cities in the index. In terms of a relative price level analysis, it is not possible to justify the home price level for the top 5 overpriced cities by reducing the 30-year fixed-rate mortgage loan interest rate from 4.07% to 0%. Therefore, in order to classify the homes in the top 5 overpriced cities as underpriced, it would need to be deemed prudent by prospective homebuyers to spend more than the justified percentage of household income amount. As an alternative, in order to justify the median home price level for each city, the median required household income level would need to increase to a level within the respective range of $93,556 and $227,252. Finally, based on the median household income level, the quarter-ending national average mortgage loan interest rate, and the assumption that no more than 28% of pre-tax household income should be spent in order to repay the principal and interest costs of a mortgage loan, the justified home price level for the top 5 overpriced cities fell within the respective range of $271,993 and $408,883 $853. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to accurately assess the level of overpricing or underpricing of homes in their community. On the other side of the spectrum, 44 cities that make up the Atkins 60 City Home Price Index were classified as underpriced for the second quarter of this year. Buffalo, Detroit, Milwaukee, Memphis, and Huntington were identified as the 5 most underpriced cities in the index. In order to classify homes in the top 5 underpriced cities as overpriced, the national average mortgage loan interest rate would have to increase from 4.07% to more than the justified mortgage loan interest rate amount for each city, or it would have to be deemed imprudent by prospective homebuyers to spend as much as the justified percentage of household income amount in order to repay the cost of a mortgage loan. Prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to accurately assess the level of underpricing or overpricing of homes in their community. Given the events that have transpired in the residential housing market, and taking into account the fact that buying a home will likely be the largest single financial transaction that prospective homebuyers will ever make, and the bulk of their net worth will likely be tied up in their home, prospective homebuyers should use the Atkins Residential Home Valuation Analyzer in order to analyze residential real estate from 5 financial perspectives. By assessing residential real estate in this manner, prospective homebuyers will be able to make a prudent home purchase decision. For more information about the Atkins 60 City Home Price Index, to watch our catalog of residential housing movie presentations, and to subscribe to use the Atkins Residential Home Valuation Analyzer, please visit the Atkins Capital Management website at residentialrealestateanalysis.com. Thank you for taking the time to listen to this presentation.